Hello everyone. We are now on learning outcome number 2, financial reporting and analysis. We want to talk about accounting policies. Accounting policies, these are policies for the organizations which direct the company in the preparation of financial statements. Accounting policies for these companies are different. Each company adopts different accounting policies. For example, let's look at depreciation. A company can set the rate of depreciation for its vehicles at 10% using the diminishing balance method, yet others can set at 10% using the straight line method. So these are different accounting policies. So that's accounting policy. Each company have to have its own policies regarding the preparation of financial statements. Right. This includes any accounting methods, measurement, system, and procedures for presenting disclosures. Accounting policies serve as evidence that accounting transactions are evaluated in a systematic manner. Adhere to these policies shows that transactions are processed in the same way. So accountants examining internal control can use accounting policies to help follow transactions throughout the accounting system. The Companies Act stipulates that each financial statement must be accompanied by the cash flow statement. The cash flow statement need to be prepared and must accompany the financial statement. It is also stated in the International Accounting Standard 7, which stipulates that a cash flow statement must be prepared. The cash flow statement, it portrays how a company have spent its cash and how it has actually used its cash. It informs the reader of the business the current cash position. How much do we have? How much did we start with? How much did we get? How much did we spend? And what's the current position? That's the cash flow. For a business to be successful, it must have sufficient cash all the time. It needs cash to pay its expenses, to pay loans, to pay taxes, to pay its employees, to purchase new assets, etc. etc. A cash flow report also determines whether a business has enough cash to do what it wants to do. Let's now go to the layout of the cash flow statement. The cash flow statement consists of 3 main sections. We have what we call the cash flow from operating activities. This is the main income generating activity of the company. For example, if you are in the business of buying and selling, so your cash flow from operating activities is from sales. Maybe you are in the business of rendering service such as medical, so service rendering is your operating activity. So this income from the operating activity will come under this heading, cash flow from operating activities, and all the expenses involved must also come under this heading, cash flow from operating activities. Let's go to the next one, cash flow from investing activities. We know that as businesses, we don't just wait for cash flow from operating activities. If we happen to have extra cash, we have to invest elsewhere. It could be investing in the bank or investing in assets, buying property, equipment, etc., etc. So the income which we get from such investment will have to come under this heading. So all these expenses involved, suppose we have land and buildings and we are getting income from there, we have to uh, record the income from that investment under this heading. All the expenses for that investment will also come under this heading as a deduction. We are now going to the third one, which is cash from financing activities. Cash flow from financing activities is actually financing the business, such as the capital. Sometimes, if companies identify that they need more cash, instead of asking for cash from elsewhere, they can ask the shareholders to inject more funds, that is issuing more shares. This is recorded under this heading, cash flow from financing activities. You can also borrow from the banks, etc. All those funds will come under this heading, and the expenses involved will also come under this heading as a deduction. These totals of cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities will be reconciled, that is adding or subtracting if it is a negative figure, to arrive at the fourth section, which we call the net changes in cash and cash equivalent. Let's go to the next item, which we want to talk about: accounting concepts. We have several accounting concepts which we need to know. We have what we call the accruals concept. Accruals concept states that profit is the difference between revenue and the expenses incurred in generating that revenue. So we say revenue minus expenses is equal to the net profit. So accruals concept talks about the difference between the revenue and the expenses. These revenues and expenses must be incurred in the same period. That is, let's say our year ends in December. The revenue for the year from January up to December must be compared with the expenses for the same period. That's the accruals concept. The next one is the historical cost concept. Historical cost concept means that assets are normally shown at cost price. When we are recording the assets, that normally the non-current assets, they are recorded at cost price always. If there is any deduction which need to be done, for example, the deduction for depreciation, we have to start at cost. Then we show the depreciation charge and the current value of our asset. That's the historic cost. We don't just start from the current position, that is the current value of our assets. We need to know the cost of this asset. That's what we call the historical cost concept. The next one is the going concern. The going concern means that we assume that the business will continue to operate for the foreseeable future. That is for at least 12 months after the end of the reporting period. We don't operate with the assumption that anytime soon the business is going to end. Let's now go to the next item which we want to discuss. This is the rules-based versus the principles-based accounting. The rules-based accounting means that every company have to follow a set of rules that is complying with all rules and regulations according to the GAAP, that is the generally accepted accounting principle. The principles-based accounting suggests that companies must comply. If they don't comply, they have to explain the reasons why they didn't comply. So here we are saying they must comply or they must not comply, that is adopt other principles, but they have to explain why they have done that. This is according to the International Financial Reporting Standards. That is the end of our discussion today. Thank you.